All right, let's get started. Today, we're tackling something absolutely foundational in accounting, the books of original entry. Honestly, if you want to succeed at the AS level, you've got to get this right. So, let's dive in. So, here's our plan. First, we'll figure out exactly where these books fit into the bigger accounting picture. After that, we'll look at the paperwork that kicks everything off. We'll explore the main day books, and then we're going to spend some extra time on two really important things: the cash book, which is a bit of a special case, and the difference between trade and cash discounts. Finally, we'll connect it all to the ledgers and wrap up with some key principles you'll need for your exams. Okay, so to really get a handle on what day books or books of original entry are all about, we have to start by looking at the entire accounting process from a bird's eye view. Think of it like this: every financial event, every transaction, creates a piece of paper, a source document. Now, where's the very first place that information gets written down in the accounting system? That's step two, the books of original entry. It's only after this first step that we move on to the ledgers, the trial balance, and finally the big financial statements. So you can see just how important this is. The daybooks are basically the official starting point for all the data. So what is a book of original entry, really? Well, you can think of it as a diary or a logbook for the business's finances. It's where we make the first chronological note of transactions. It's like a sorting bin where we group similar things together before they go into the main accounting system. And here's a really key point to remember. For the most part, these books are just lists. They are not part of the double entry system. There is one major exception to that rule, but we'll get to that in a bit. All right, so what actually makes us write something in these books? Well, you can't just record things without proof. Every single entry needs to be backed up by evidence, and that evidence is what we call a source document. First things first, there has to be a transaction. And what does that mean? It's any exchange of goods or services that you can measure in money. A sale, a purchase, paying a bill, all transactions. The golden rule is simple: if you can't put a price on it, it has no place in the accounting records. And here's where that proof comes in. Every transaction leaves a paper trail, and that trail is made of source documents. As you can see, if you make a credit sale, you'll have a sales invoice. If a customer returns something, there's a credit note. This isn't just paperwork for the sake of it. These documents are the raw data, the evidence we need to make our entries in the daybooks. Now, imagine a busy business. They have hundreds, maybe thousands of transactions every month. It would be an absolute mess to just throw them all into one giant list, right? That's why we don't. We use different daybooks for different types of transactions. It's all about keeping things organized and making the process much, much more efficient. Let's look at the main players. Here we have four daybooks that handle the most common credit transactions. The sales daybook tracks everything you sell on credit. The purchases daybook tracks what you buy on credit. Then you have the returns books for when things come back, the sales returns daybook for customers sending things back to you, and the purchases returns daybook for when you send things back to your suppliers. See the pattern here? All four of these are about one thing: credit transactions involving the goods you trade. Okay, that's great for sales and purchases, but what about all the other stuff? The odd transactions that don't quite fit in those boxes. What if you buy a delivery van on credit, or you have to write off a debt because a customer can't pay? Where do those go? Well, for all these misfit transactions, we have one final book of original entry: the General Journal. The General Journal is basically the catch-all. It's designed for all the non-routine, less frequent stuff. Things like buying a big piece of equipment on credit, accounting for depreciation, officially writing off a bad debt, or even just fixing a mistake you made earlier. Pretty much, if it's not a standard credit sale, purchase, or return of your regular inventory, its home is the General Journal. So far, we've talked a lot about credit, but what about actual money changing hands? Every single movement of cash and every transaction through the bank account is recorded in one very special, very important book, the cash book. Now, if there is one thing you absolutely must remember from all of this, it's this: the cash book is unique. It's a hybrid. Why? Because it's the only book of original entry that is also part of the double entry system. It's a daybook and a ledger all rolled into one. This makes it incredibly efficient because you don't have to post the entries to another account later. It's a one-stop shop for everything cash and bank. So let's take a look at how it's set up. A standard cash book has 3 columns on each side. The left-hand side is the debit side. This is for all the money coming in. You'll see columns for any discounts we give to our customers, for physical cash we receive, and for money deposited into the bank. On the right, you have the credit side. This is for all the money going out. Here you'll find columns for discounts we get from our suppliers, cash we pay out, and payments made from our bank account. The logic is actually very straightforward. Debit what comes in, credit what goes out. Simple as that. Money received is a debit, money paid is a credit. And the discount columns just follow suit. A discount you allow to a customer is an expense for you, so it sits on the debit side with the receipt. A discount you receive from a supplier is like income, so it goes on the credit side with the payment. Speaking of those discount columns, this brings us to another area where students often get tripped up. You see, in accounting, the word discount can mean two very different things. It is absolutely crucial for your exams that you know the difference between a trade discount and a cash discount. Let's break it down. A trade discount is all about encouraging big orders. It's a price cut you get right there at the point of sale. A cash discount, on the other hand, is about encouraging fast payment. It's a reward you get later if you pay your bill early. But here's the most important part for us accountants. The cash discount gets recorded in the cash book. The trade discount, it never even shows up in the accounts. I really want to hammer this point home because it's a classic exam topic. A trade discount is nothing more than a calculation. It's a deduction from the sticker price. So if the list price is £100 and there's a 20% trade discount, the actual transaction price is £80. That's the number that gets recorded. The £20 discount, it's like it never existed. It is completely invisible in the accounting records. Okay, so let's recap. We've taken our source documents, our proof, and we've neatly sorted all our transactions into the right daybooks. So what's the next step? Well, now we have to post this information into the main accounting books, the ledgers. This is where the real work of double entry bookkeeping begins. The ledger is the heart of the accounting system. It's a collection of individual accounts, often called T accounts, for everything the business owns, owes, or earns. The totals we've calculated in our daybooks get transferred or posted here. For instance, the grand total from your sales daybook will end up as a credit in your sales account and a debit in your trade receivables control account. This is the double entry system in action. Now, to keep things tidy, we split the main ledger into three parts. First, you have the sales ledger. This is basically your address book of everyone who owes you money, all your credit customers. Then you have the purchases ledger, which is the opposite. It lists everyone you owe money to, all your credit suppliers. And finally, the general ledger contains everything else, your assets like buildings and vans, your expenses like rent and wages, and your capital. All right, that's enough theory for a moment. Let's get practical. How does all this actually look in an exam question? We're going to focus on the cash book because it's a favorite for examiners and they love to include tricky little adjustments. Here are some of the key adjustments you need to be ready for. First, contra entries. This is when you move cash from the till to the bank. You just credit the cash column and debit the bank column, an entry on both sides. Second, dishonored checks. If a customer's check bounces, you have to reverse the original entry by crediting the bank. Third, drawings. If the owner takes money for personal use, that's a credit entry because cash is leaving the business. Fourth, capital versus revenue expenditure. If you buy a van, that's capital expenditure. It's a credit to the bank, but it's not a day-to-day running cost. And finally, make sure you know the correct balancing procedure inside and out. So let's end with a final thought to tie this all together. At the end of the year, a company produces its big financial statements. But where does the information for those statements come from? It comes from here, from these books of original entry. So how does getting this first step right, recording everything carefully, systematically, chronologically, ensure that the final numbers are accurate and trustworthy? Well, that's the whole point, isn't it? Get the foundation right, and the rest of the structure will be solid.